$30 billion. Not in revenue, not in profit, in cash burned. That's OpenAI's projected cash burn for 2026 alone. Next year, 2027, it jumps to $57 billion. By 2030, the cumulative bleed reaches $665 billion. Nobody in the history of capitalism has ever burned this much money and survived. Except, of course, if somebody else pays the bill. Look at a picture of Sam Altman right now. Relaxed, controlled, almost amused. He runs a company valued at $500 billion on the secondary market, heading toward $830 billion in the next round. A company that loses $1.35 for every dollar it earns. A company that, by Sam's own financial documents, will not be profitable before 2030. And yet the IPO is coming. Fourth quarter 2026, according to Fortune. Possibly $1 trillion listing, according to Altman himself. The largest private funding round in history has already closed. Anthropic is lining up behind. $380 billion in valuation, preparing its own exit. The entire Silicon Valley machine is gearing up for one final push. And at the end of that push, there is a door marked IPO. And on the other side of that door, somebody has to be standing there. Somebody has to buy what the insiders are selling. That somebody is you. This isn't a video about whether AI is real. The tech is real. ChatGPT works. Claude works. This is a video about something much older than AI, about how a small group of people turn a revolution into a payout, about how the public market gets used, not as a fundraising milestone, but as an exit, and about why the biggest retail trap of the decade has already been set. To understand what's happening, forget for a second the headlines about AGI, about Sora, about GPT-5. Follow the money instead, because the real story isn't in the product, it's in the cap table. OpenAI was founded as a nonprofit in 2015. In 2019, it became a capped profit structure. In 2025, it was restructured again into a public benefit corporation called OpenAI Group PBC. Each restructuring had the same effect, loosening the grip of the nonprofit mission, tightening the grip of the shareholders. Microsoft, the first major investor, now sits on 27% of the for-profit entity, worth around $135 billion on paper. Employees hold tens of billions more in vested shares. Early VCs, Thrive Capital, Khosla Ventures, Founders Fund, have multiplied their original checks by factors of 50 to 100. None of this wealth is real yet. It's what finance calls paper, unrealized gains trapped inside a private company. And paper in finance is a problem. You can't buy a house with paper. You can't retire on paper. You can't diversify out of paper. The only way to turn that paper into actual, spendable generational wealth is to sell it. And the cleanest way to sell at scale, without collapsing your own price, is to bring the whole thing public. To let millions of retail investors buy pieces of it at full price over years. That's what an IPO is. In textbook terms, it's a company raising capital. In practice, in 2026, it's an exit ramp. Early investors dump, executives dump, employees dump. The company itself raises a comparatively tiny amount of cash because it doesn't really need public money. It just needs to create a liquid market where insiders can walk out the door. The deeper that market, the bigger the door. Sam Altman gets this. That's why, publicly, he has said, in interviews with Fortune and at the DealBook Summit, that going public could be really annoying, that he's 0% excited about the prospect. But behind the scenes, his own CFO, Sarah Friar, is openly pushing for an IPO filing in late 2026, listing in 2027, target valuation close to $1 trillion. The disagreement isn't whether to go public, it's how fast. The delay game is mostly theater. The exit is already being built. On the other side of the rope, Anthropic is running an almost identical play. A $30 billion funding round closed in February at a post-money valuation of $380 billion, up from $60 billion only a year earlier. Internal projections target a listing as early as October 2026, raising potentially $60 billion. Same structure, same cash burn profile, same bet. Take it public before the music stops. This is the setup. Two companies, burning a combined $50 billion a year, sprinting toward the public market. And behind them, a line of hyperscalers, chip makers, and funds whose entire balance sheets now depend on what happens when those shares hit the Nasdaq. One detail makes the picture sharper. AI startups in 2026 have started pricing the same equity at two different valuations, simultaneously, inside a single round. TechCrunch documented the practice at Aru, at Serval, at others. Lead investors buy a block at a lower real price, then the rest of the round gets labeled at the unicorn headline number. Redpoint took part of Aru at $450 million, then stuck a $1 billion label on the rest. The tactic exists for exactly one reason. Insiders know the real number, and retail-facing marketing needs the bigger one. It's the mechanism of a narrative market, not a fundamental one. And it's the template the IPO roadshows will inherit. Now the numbers. Because the numbers are where the story stops being abstract. OpenAI's own projections, leaked via the information and confirmed across WSJ and Fortune, sketch out the most aggressive cash burn ever committed to paper. $25 billion burned in 2026, $57 billion in 2027. Adjusted gross margins down to 33% against an internal target of 46%. Inference costs quadrupled in 2025. Training expenses alone projected to hit nearly $440 billion by the end of the decade. Cumulative cash burn through 2030, $665 billion. An additional $111 billion was added to the forecast in a single revision, because the company now admits its compute costs are scaling faster than its revenue curve. Put that next to the valuation. $500 billion in the most recent tender offer, $830 billion in the pending funding round, a target IPO price zone near $1 trillion. For a company that spends $1.35 for every dollar it earns, according to the same leaked documents. Revenue in 2025, around $13 billion. Losses, about $5 billion before aggressive assumptions. Projected profitability, 2030. 6 years of continuous losses between now and then, assuming nothing breaks. No tech company has ever sustained this shape. Amazon, Facebook, Google, the usual comparisons, all reached gross margin profitability within 5 years of their founding. OpenAI is in its 10th year. Amazon at that stage was already printing operating cash flow. OpenAI at its 10th is digging deeper into the hole faster. Then look at the Microsoft clause. In October 2025, the restructuring agreement locked Microsoft into a 20% cut of OpenAI's total revenue through 2032. 20% off the top. Every dollar OpenAI earns, 20 cents walks straight to Redmond for 7 years, including, per the contract, access to post-AGI models. Meaning that even if OpenAI invents the thing Sam Altman has been promising for a decade, artificial general intelligence, the upside is already diluted by a fifth, contractually, legally, for Microsoft, before a single public shareholder touches it. That's not a partnership, that's a tax. A tax OpenAI signed because it desperately needed the compute and the cash back in 2023. Now the third leg, the Nvidia deal. Announced in September 2025, extended through 2026, up to $100 billion invested by Nvidia into OpenAI. In exchange, OpenAI agrees to buy at least 10 gigawatts worth of Nvidia GPUs. Jay Goldberg at Seaport Global called it asking your parents to co-sign your mortgage. New Street Research estimated that for every 10 billion Nvidia puts in, it gets 35 billion back in GPU purchases. Stacy Raskin at Bernstein used the word that matters, circular. Bloomberg ran an entire graphic series mapping it out. The Register called it the $1 trillion loop. Here's the loop in plain English. Nvidia gives OpenAI money. OpenAI uses that money to buy Nvidia chips. Nvidia books the revenue. Nvidia's stock goes up. Nvidia uses the higher stock price to raise more capital or reinvest. That capital goes back into OpenAI, which buys more chips. Same dollars, rotating. Same ecosystem, inflating its own valuations by moving paper between balance sheets. Oracle joins via the $300 billion Stargate deal. AMD joins via a 6 gigawatt commitment in exchange for a 10% warrant stake. CoreWeave joins via a $22 billion OpenAI contract, backstopped by Nvidia's own $6 billion capacity guarantee. This is not a conspiracy theory, it's accounting. It's the exact pattern telecom equipment makers ran in 1999, when Cisco vendor financed a generation of networking startups that bought Cisco routers with Cisco money. When the music stopped in 2001, those customers couldn't pay. Cisco lost more than 90% of its market cap in 18 months. The dollars had been real on the way up. The revenue had been real. The product had been real. The problem was the circle. Aswath Damodaran, the NYU finance professor known as the Dean of Valuation, put it bluntly. The AI industry needs 2, 3, 4 trillion in real outside revenue by 2030 to justify current infrastructure spending. Current global AI enterprise spending, around $37 billion in 2025. The gap between what's being spent to build AI and what customers are actually paying for AI is roughly 2 orders of magnitude. Somebody, somewhere, eventually has to close that gap. And there's a quieter statistic that bears thinking about. MIT research published in August 2025 estimated that 95% of organizations deploying generative AI are getting zero measurable return on their investment. Zero. Not negative, not marginal, zero. Meaning the enterprise revenue that's supposed to justify $665